Hi everyone, welcome back. Thanks for joining us today. I have a special guest, one of my dear friends and mortgage broker, Pauline Amstutz with Golden Eagle Mortgage in Hollister. I am so thrilled to have her here today. She's just offers a wealth of information when it comes to home loans and the mortgage industry. So I would like to welcome you, Pauline. Thank you for coming. And can you tell us a little bit about yourself and about Golden Eagle Mortgage?
Hi, Donna, and thank you for having me. I totally appreciate it. I started Golden Eagle Mortgage in 1999 with the dream of helping my clients achieve home ownership. It quickly became a passion that I just fell, deeply for. I've really taken a lot of time and effort to, study the industry, keep up with the industry, which
is ever changing
every day.
Yeah.
And, just making sure that, I can able to give my clients what they need in regards to a home purchase, a refinance. And I think the most important thing when you're dealing with clients is making sure that you are doing what's best for the client. You're meeting each individual client's needs because they're not all the same.
Right.
And that's what I take, deep responsibility, making sure that I am coming across to the clients to where they understand the process, because in all honesty, it can be very overwhelming, stressful, and it's our job to hold their hand. Whether they are a first-time home buyer, whether they are refinancing, it is our job to make sure we're doing everything that we can. We're ensuring we give the clients the needs that they are looking for in the home process. Because I truly believe you take care of the clients, they're definitely going to take care of you.
Absolutely.
Bottom line, that is my motto.
Yes, absolutely. And you do that. I feel that you and your team definitely do that, which is why you're my preferred lender. And Golden Eagle Mortgage has the reputation that it has with our local agents, not just our local agents, but even beyond our community with other agents, and the relationships that we've built is because of you and your team and how you take care of our clients. So from an agent's perspective, I want to thank you for that, because that's very important. So I'm going to just ask you some questions, if you don't mind, just regarding the process in general. So I'm a first-time home buyer. I'm coming to you for the first time. What is the process? What is the first thing a buyer, a potential buyer, would do when they meet with you? And is there a cost to that?
So the first thing, the client will reach out to us. We'll make initial contact with the client. We will explain to them the first part of the process, which is all the documentation needed from them in order to put their pre-approval together. At that point, once we receive all the documentation from the client, which normally, once we receive the documentation, it will take approximately 72 hours to complete their pre-approval. Now, it may be longer if we need to obtain a verification of employment, because their income, you cannot figure out just by looking at a W-2 or a pay stub. And so once we have all the documentation in place to where we can truly sit down with the client and discuss their pre-approval, and then we move forward from there.
Okay, so as far as the documentation goes, is that something that they get the list ahead of time, a buyer will get ahead of time, or do you tell them what to bring? How do they know what documentation to bring, in other words?
When they initially reach out to us, then we will get their information. Normally, a loan officer like myself will make that initial contact to them. We will explain kind of the process as how it's going to go, just the initial. We will get more involved in the process once we have all their paperwork and the pre-approval complete. What we ask for is to get all the documentation in advance, because then when we go to sit with you, we're able to have all your information and be able to explain what loan program that you will qualify for.
Okay.
So how we get that information, my assistant Yasmin can either email them directly, or they can come drop off the paper papers in person at our local office here in Hollister, or they can go to our website, goldeneaglemortgagegroup.com. They can also apply online on our website and also retrieve the documentation list needed in order to move forward with pre-approval process.
Okay, so it's a pretty simple process for a buyer to just
Yep.
start the initial, right?
Yeah, and the most important thing is explaining all the steps as we move along with the clients. Now, of course, if you've had a home loan before, you're going to kind of know. But if you've never worked with me, I am going to start the process just as if you were a first-time home buyer, just because I want the information coming from me and not maybe from a previous lender you may have used, because maybe that's not the way I run my business or how I have my flow of the process.
Right, right. I love, yeah. And so is the documentation that you're speaking of, the required documents, like you said, you have a list a buyer can refer to online, but is it the same for somebody that is self-employed as far as like W-2? Because I know you mentioned W-2s, but if somebody's self-employed, is there different documentation for?
If you're a self-employed borrower, you will have to provide your business tax returns, your business license, anything that would pertain to you being self-employed. We will require and request those documents from you.
Okay, yeah. So does somebody technically have to be employed in order to obtain financing, to obtain a mortgage loan? Like, if they have other sources of income, I guess is what I'm asking. So they're not necessarily employed, but maybe they receive Social Security or rental income.
Yes, you do not have to be employed to apply for a mortgage loan. Basically what it is, if we can prove source of Social Security, pension, spousal support, alimony, rental income, in any source that we can prove we have a 3-year continuance, the lender will take that as income.
Well, that's good to know, because I think most people are under the misconception that you do have to be employed in order to obtain financing or apply for a mortgage loan.
Correct.
So, yeah.
And please, reach out to us. We'll be able to tell you the different type of incomes that will qualify. And some clients, they have a big interest income coming in from a investment, and we have proof of it coming in, and we'll have proof of it to continue. That's also, another source of income. So there's a lot of different scenarios. Just reach out to us and we'll be able to explain to you what qualifies and what doesn't.
Okay. I think, so as far as, I'm going to speak as far as an agent, a realtor dealing with a buyer. The biggest concern that I think I get most often from my buyers or clients is that our credit. It's the credit. So can you talk a little bit about how credit plays a factor in obtaining financing, kind of like what the ideal credit score would be, but also maybe not what the highest score is, but would still be able to qualify a buyer for a loan?
Okay, so not to scare everyone, ideal credit score, 780.
Okay.
You want the best rate and maybe, more programs available to you. Yes, 780 is the ideal score. But, of course, that is not the normal, right? Mm-hmm. So basically, any FICO score, say, let's use an example of 700, okay? You will qualify for a loan, but you might not have the best interest rate compared to the 780.
Okay.
Now also, when it comes to interest rates, it also factors a lot of different programs you will or you will not qualify for. For instance, on an FHA loan, we can go all the way down to 580. Now, you're going to pay for that interest rate because, unfortunately, the credit is low. We will take the time to explain to a borrower what can they do to improve their credit score. We will give, tips on what they would need to do. Maybe paying down a credit card that might be above 50% of the max limit. Now, we will give those suggestions. It's up to the borrower if they want to make that move and make those changes in order to maybe qualify for a better interest rate, which could take time.
Right.
So when you go to pay off a credit card down to below, say, 10%, what happens is it takes the credit bureaus 30 to 45 days to report that before that score is going to show an improvement.
Okay. So what about, speaking on credit, when a buyer meets with you for the first time and they bring in all their paperwork and now you've ran the credit score and you like, it's not probably the ideal score and they want to try to improve that score. But I know a question a lot of them have, or the buyers that I meet with have, are, you're going to run my credit. How is that going to affect my credit? Is it going to drop their score? Like if they're trying to improve it and now they gotten their credit score ran, or their credit ran, is that going to drop the score?
Okay, so normally when you're obtaining a mortgage loan, a credit report, normally it's not a hard hit.
Okay. Meaning?
Okay, compared to a credit card, an auto loan, those are going to hit your score more than a mortgage loan. Now, let me explain. You're shopping around to different mortgage companies, correct? All right, well, you're concerned because you just met with ABC down the street. You didn't care for them. You just didn't, you just didn't
vibe.
connect.
Yeah.
Okay, and so then you come to me and you're like, wait a minute, they just ran my credit. Is this going to hurt my score? There's a 30-day window period that you have when you're doing any mortgage credit inquiries, okay? So basically, if you just met down the street with ABC lender and then you 2 weeks ago you come to me, your score shouldn't be affected. Okay? So remember, when your credit is ran for a mortgage loan, it is not a hard hit in compared to credit cards, auto loans, etc.
Okay.
Does that make sense?
Totally. Okay, so another topic in regards to credit. A lot of times I have buyers come to me for the first time. They haven't yet met with you or any mortgage broker for that matter. And they say, oh, well, I went to a third-party site like Credit Karma, for instance, and my credit score is 700. And then they meet with you and their credit score comes back at like 680 or 620. Is that reliable, or why does that happen? Why is there such a difference in what they obtained from Credit Karma versus what they're getting from a mortgage broker?
Well, because we go through the three main credit bureaus: Equifax, TransUnion, and Experian. That is the true scores that we're going to receive. You can check those sites out, but just remember that when we go to run the credit, we will be using the three credit bureaus that I mentioned earlier.
Yeah. And is it a average of those scores? Because they're going to be different, correct? They're not all going to be the same.
Yeah. Most likely, they're all different scores. We will take the middle of the lower. So an example, we have two borrowers. We got a husband that has, all high sevens, and the wife has all mid sixes. We're going to take the middle of the lower of the wife. That's what we need to use in qualifying the client.
Okay. Is it best sometimes in a scenario, let's say the husband may qualify for the loan on his own, he's got the better credit, would you not have the spouse, or do you have to have the spouse if you're married? If that makes sense.
No, totally makes sense. So basically, no. Let's just say I have two borrowers. I got the husband, I got the wife. We just talked about the wife has a lower credit score in the mid sixes. The husband has the higher credit score in the mid sevens, and she is a homemaker. Therefore, since we don't have income coming in from the spouse, I will have the conversation with the clients and say, hey, this is the best way to go because these are the reasons. Normally, clients are very good about it. They want the best rate. They want the best program.
Right.
And if it means, okay, taking the wife off the loan, now we will put her on title at the closing. So it's not like she's not going to have the ownership to the house. Now, this goes for men and women because sometimes we have the woman
Right.
that is the main provider.
So staying on the topic about credit, because credit does play a huge factor, right, into obtaining a home loan. How does a past bankruptcy or foreclosure, I guess, affect a buyer's ability to get a home loan?
In regards to a bankruptcy, foreclosure, per individual client, we will explain to them the process on what it's going to take to get to the next step to be able to qualify again in the future. One of the most important things are reestablishing your credit because that is what's going to open the door to be able to qualify in the future.
Okay. So it is obtainable. I mean,
Of
someone
course
can
it is. There's just
definitely
timelines we have to meet in order to be able to now qualify to
get that home.
purchase, refinance, whatever it may be.
Okay.
You know.
Yeah. Every situation is different.
Yeah, every situation, yeah.
Now, I do know that sometimes some of my buyers get a cosigner when the credit isn't up to par, or maybe the income, they're not meeting those income levels. Is that a good idea for a buyer to get a cosigner? And maybe explain exactly what a cosigner's responsibility is when obtaining a home loan.
So a cosigner is basically going to help the buyer qualify. So let me give you a scenario. I just met with a client. She's a new nurse. She's been on the job for 6 months. Well, she's only been on the job for 6 months. Therefore, her income is a little bit all over the place. She works nights, she works days. Well, what a lender wants to see, they're fine with her being on the job for 6 months because she just graduated with a 4-year degree. And therefore, they're counting that as time on the job because normally the lenders want to see you 2 years on the job. With exceptions, we could do 18 months with exceptions. So we can't just average the income because we can't take the night pay with the day pay because we don't have that 2 years to average. The investors want to average overtime, bonus, commission over a 2-year period most of the time. We do have exceptions of ways to get around maybe some timelines, but that will be us putting that file together to where we feel so strongly about it, we will go to upper management and say, hey, look at this file, we believe in it, here's all the facts we've produced for you to make that educated decision on, yes, we will loan to this borrower. Now, so what happened with this borrower is I was able to obtain a verification of employment, which broke out her income. Bottom line is, I could still only take her hours, which are guaranteed 36 hours a week. I can't take all that other pay to qualify. So her son decided to co-sign with her. He does live with her, although he doesn't need to live with her.
To be a cosigner.
To be a co-signer.
Okay.
In this situation, he does. So he's coming on to co-sign for her. Once she could prove that income, which is the higher income that we can't use until she has 2 years on the job, then she will refinance eventually, take the son off, and then she will obtain the loan on her own.
Okay. So that's, yeah, because that's a huge concern for a lot of my buyers is maybe either that credit might be the issue and could we get mom or dad on the loan with us or a child or, you know, it's the credit or it's the income tends to be the two biggest concerns that I get.
Correct. And also, there's other ways. Let's just say that grandma and grandpa want to give you $50,000 because you're like saying, we don't qualify. They find out, which this happens a lot actually.
Yes. Yeah.
The grandparents will come in, the parents will come in, the aunts, the uncles will come in and say, hey, we really want you to have this home. We want to gift you $50,000. We want to gift you $100,000. We actually want to gift you the whole down payment and closing costs. It's fine. Not a problem. We do it all day long.
And grandma and grandpa, do they have to be on the loan, or mom and dad, if they're gifting the funds?
They do not. We just
Okay.
have to document where the gifts are coming from. So for instance, we'll give a gift letter over to the borrower. They will give it to the appropriate relative. They'll fill it out. They'll show where the money is coming from. And then therefore, once we have to verify, we normally will get a receipt of the family member giving the money over to the buyer. Now, that might be in a form of a wire. That might be in a form of a check. We just have to verify the money came out of that account of the donor that is gifting the funds.
Okay. And does it have to be a relative, or what if you have a great friend that wants to loan you
If it's like-
$50,000 or gift you $50,000?
Now, if they're a close friend that is considered a relative, in your eyes, which I have some of those people in my life, yes.
Okay. Good to
We'll
know.
just document with a letter of explanation and move from there.
Okay. So it is possible.
Yes,
That's
100%.
awesome. Yeah. So can you explain the concept of debt to income ratio?
Yes, very good question. So basically how we qualify a borrower is we have a front end ratio and a back end ratio. All the front end ratio is housing. Back end ratio is housing, all your other debt, credit cards, student loans, auto payments combined. So depending on what program we're going to do, there are qualifying ratios. Some programs we can go higher, some we have to go lower. So basically that is the most important thing, is when we are evaluating the borrower to determine.
Okay. Now, one of the, I know this has happened, so I'm just speaking from my experience working with home buyers. Sometimes a buyer is looking at a single family home, but then also probably considering a townhome, let's say. And often townhomes or condos, as you know, have HOAs. And there's even some single family homes that have HOAs. Is that looked out as a debt? Or how does that affect, like you've qualified the buyer for X amount, let's say $500,000.
Correct.
But now they're decided we're going to purchase a townhome, and the HOAs on this townhome, let's say, are $300 a month. Will that have any effect on that mortgage, on the ability to qualify for that dollar amount?
That will be considered in your housing front end ratio.
Okay.
So yes, we will factor that in because that is part of a debt that you have that we have to use to qualify you. Once we are complete with the pre-approval process, then we will go ahead and reach out to the real estate agent, let them know they're qualified, they're ready to start looking. They get into contract. At that point, we will get the contract from the agent. We will get the prelim from title and any HOA documents if needed. We will go ahead and put the file together. We will submit to underwriting. What the underwriter is going to do, they're going to verify all the documentation that we have provided. When they do that, there might be some extra conditions that maybe a condition wasn't clear, or they want an additional condition to complete the verification process, whether it be a verification of employment, maybe their assets weren't seasoned long enough, and now they're going to say, hey, we can't use these assets because we don't have a 2-month seasoning. So from there, we will make sure that we meet all of the conditions the underwriter's requiring, and once we've submitted everything, we are now down to the end of the process. We will then get our CD out, which is called a closing disclosure. It's going to go over the final numbers that the client is going to need in order to proceed with the close of escrow. At that time is when we will review with the borrower a good estimated of funds that we will need to close.
Okay, Pauline, so say the borrower or buyer doesn't find a home right away. As you know, right now in this market that we have very little inventory. So for most buyers, especially a lot of the buyers I'm working with, it's taking anywhere between 1 to 3 months to even find a home, to enter into contract. Will anything change in regards to the pre-approval if my buyers do not enter into contract within that first initial 30 days?
So what we converse with the client is basically we need to update your loan approval once a month, whether it's the pay stubs, the bank statements, anything relevant to changes that may have happened in this amount of time. Okay. So therefore, as you just said, that it could get into a multiple offer situation where we want to be ready and we want to make sure that file is complete and ready to go. If we have to go in and try to beat out other offers by making the terms different, for example, 21-day closes. If we have a complete file and we are ready to rock and roll, we can make that happen.
21 days as opposed to
30 days, 45 days. But most importantly is we want to be prepared that when we give out that pre-approval letter and it gets accepted, their contract, we are prepared to make things happen and to deliver what we offered to the borrower.
Okay. And within that same scenario, if the interest rates change, as you know right now, the mortgage industry, the rates have been up and down. They haven't been consistent. So at what point would you advise a buyer to what we call, or you call, lock in their interest rate? Is that going to affect anything?
So normally, unless they're into contract, I normally do not lock in an interest rate. But with the exception of a new home construction, I may, depending on the volatility of the market, I may lock them in because I know an end date. Now, when your client is out there looking for a home, we're not into contract yet.
Right.
We do not lock in an interest rate. At least I do not. So as we have heard in the recent markets, the Feds just spoke, the future is the rates are going to gradually start to come down. Hopefully by the end of the year, we're going to see them into the low fives, okay? But let's get back to locking that loan. If I see that the trend, the rates are starting to drop, and I have a client has a 45-day escrow, I may just let it float. But that's my expertise. You depend on me to lock the loan at the best time for the borrower, which is basically watching the market.
So getting back to the new construction, let's say the new construction home is delayed or out 30 days due to weather, materials not coming in on time. So now it's 30 days until they're going to close from the expected, say it was a 90-day, and now it's 30 days more. What happens then?
So that does happen, by the way, because especially in the winter, there's never, they can give you a timeline, but they'll also say that there's no guarantee. In that situation, what we do is we can do an extension so we preserve that interest rate. Because the clients get in their head, this is their payment, and all of a sudden they lose their lock because the home now isn't completed, and now I may have a whole different payment. What we do to ensure that we extend that lock so they are guaranteed that interest rate, it may come at a cost, but depending on where the rates may have went, you're insured that you're going to have that interest rate that we locked initially at.
Nice. What if the interest rate goes down?
We do have a float down policy.
Okay.
So on our float down policy, it has to be enough to be able to float down in order to lower the rate. And we do that internally. So we don't go and update the client, hey, the rates may be dropping and you might get a lower rate. We actually do that on the back end. And then if you get the news that your rate dropped, You love us even more.
Even better, right?
Yes.
Yeah. And then one thing I think is unclear to a lot of buyers, especially first-time home buyers, is that when they're purchasing new construction with developers, they often have in-house sales teams, the realtors who are selling, the sales associates, and then they also have oftentimes in-house lenders. What is the difference between working with you and working with one of those in-house lenders? Are they able to use you, somebody who's not an in-house lender?
Yes, they can. Now, basically, when you go into a new subdivision, they do have their in-house lenders. They're going to want to get you pre-approved with them. Their goal would be to keep everything in-house. They can, see the process through. But a borrower can use whoever they want, any lender that they want. They may have to get approved through the in-house lender at the subdivision, but they can always go get that second opinion, which is important because you want to make sure this is the biggest purchase that you're going to be making at this time, and you want to make sure that you are comparing apples to apples. And so I always say, get that second opinion. It doesn't hurt. A little bit of time, but time is money, right? Our goal is always to put the client in the best loan scenario that fits their individual needs.
So Pauline, oftentimes, just based on my experience working with buyers, is they visit these new subdivisions and they speak with in-house lenders and they are offered credits. Closing cost credits is typically what a buyer is offered when they are working with an in-house lender. What is that difference? Why would a buyer go speak to another lender, let's say as yourself, as opposed to working with the in-house lender who's offering them credits?
It is very important to get a second opinion because you have to compare apples for apples. For example, the in-house lender's fees might be higher than mine. And that's where you want to make sure that you compare. Maybe their interest rate's higher and mine is lower. You just want to make sure that you are doing your homework to ensure that you got the best loan for your needs. In regards to the fees of the loan, you want to compare points, fees, interest rates.
Can I stop you? What are points exactly?
So origination points are affiliated with your interest rate. So let's just say that I'm offering you a 6.5% interest rate at 1 point. Well, my competitor might be offering a 6.5% interest rate at 4 points. That's why it is so important for the borrowers to make sure they are comparing the whole scenarios from both lenders and making sure they're working with a lender that is going to explain. Because actually that is really, my goal when I'm meeting with the client. I am making sure that I try to review everything with them so they can understand. And I try to make it very clear too that this is a very deep process and that you always have to ask questions if you don't understand something. It is so important.
So how would you explain points then in terms of the fees?
For example, a client purchases a home for $500,000. I'm charging 1 point for 6.5%. 1 point, its origination point, is times the loan amount. So if your loan amount is $480,000, your 1 point is going to be $4,800. Now, you might go to my competitor, you're getting 6.5% interest rate, but you got 3 points associated with the loan.
Wow.
That's why it is so important to compare and making sure you're working with someone that is going to explain in detail what this means in comparison to the other competitor.
Right. So those credits that they're receiving is basically oftentimes a wash, in a sense, to a buyer if they're paying those high points.
Could be. And that's like I said, compare apples for apples.
Now, here's one thing we haven't touched on yet, but I really feel like it's important because it has happened. It's happened to me. I know it's happened to you. What happens when a buyer decides to make a large purchase during the loan process? Like they're in contract on a home and now they go out and get a new car for their new home, or open up a new line of credit, like a credit card for their appliances. They go to let's say a Home Depot or Lowe's, and they want to get all new appliances for the new home, and they put it on a credit card, a new credit card. What happens then?
Well, I do try to tell the clients up front, do not make any large purchases. I do make that very clear. They don't all listen.
Yeah, no.
Because that's a no, no, no. And that will affect the approval. Because when we give you a loan approval, it's on the facts of what we have in front of us. Now we let you go shopping with an approval letter. You go out and buy a vehicle and it's $600 a month. That wasn't part of the pre-qualifying process. So now you might not qualify for that $800,000 home. Now you might qualify for a $700,000 home. So if I can say anything, when you are in the middle of a loan process, do not buy anything that is going to affect the credit, which means a car, opening a credit card. Anything that is going to show up on your credit report will affect the pre-approval after the fact. Yes.
Okay. So it can completely disqualify them, potentially.
Correct. You qualify for $800,000 purchase price. Now that might take you back down to a $700,000 purchase price. Very important.
That's pretty significant.
Definitely.
So I hope all you buyers out there are paying attention to that, because I would definitely say that is one thing. Even recently, I had a situation where my client, they were purchasing their first home, super excited. A week prior to close, she calls me. She's at Best Buy getting all the new appliances, and she says, I'm at Best Buy. I'm excited. I'm getting all my new appliances. When can we go in and measure? And I said, oh, you're at Best Buy. How are you paying for those? And luckily, I asked that question. And she said, oh, they're offering a special on their lines of credit. And I said, stop right there. You are not to get any lines of credit. So that happens. Everybody pay attention. What this information Pauline is offering us is gold. I would consider it gold. So thank you for that.
Definitely.
Okay, so let me give you this scenario. The buyer decides to quit their job during the process. They've already obtained the pre-approval. They're in contract on a home. They quit their job. They found something better. What then?
So that is fine, as long as before they make that move, that they contact myself or one of my team members to review the scenario with us. So for example, let's use if you are in the trade industry and then you got this job opportunity as an editor for the newspaper. Those jobs do not connect. You're going to have a problem, okay? So if the jobs don't align in the same industry, we have to make sure that we get all the documentation to see, can we move forward with this new line of work in the new profession? They chose to leave this profession. Also, if let's just say you got a better job making more money, but the same line of work, you're fine. The lender just doesn't like to see a gap longer than 2 months. But there could be a reason. You may have to go through a 2-month background check or a 90-day background check. We just have to do a letter of explanation explaining, why do you have this gap? What was the reasoning? Oh, well, it took 90 days to do a background check, which some places do.
So once a buyer is in contract, and let's say there's a scenario where the appraisal comes in under value, especially we see that happening right now a lot because, again, low inventory, multiple offers, buyers will offer more than the listed price, but now we've got an appraisal issue where the home is not valued at what the buyer is in contract for, and the buyer doesn't have the extra funds to make up that difference. How do you handle that situation?
So normally if that happens, we will definitely approach their real estate agent and see if there's an opportunity to go back to the seller to renegotiate the value of the home.
Okay.
Sometimes the seller will not agree, and if they don't have those extra funds to make up that gap, we have a dead deal. So we try to work together as a team with the agents, with the sellers, to try to see, hey, how can we make this work and everybody's a winner?
And sometimes it happens, it's
sometimes
great,
it
and
doesn't.
sometimes it, yeah, exactly. So speaking on issues that may arise during the escrow process for a buyer, let's say there is, appraisal is done, and oftentimes I know in situations I've had, appraisers will come in and maybe they see that there is what they call a health and safety issue with the property. Maybe smoke detectors aren't working properly. Maybe there's missing stoves, ovens, ranges. How do you handle that situation? How does that work?
Well, normally, if the appraiser calls out a health and safety issue, they normally want the repairs completed before the close of escrow. For example, you have a broken window. Lender's going to consider that health and safety issue. They're going to want it fixed. So what we try to do is when those scenarios are called out, we try to address it with the agent to see the seller would be willing to fix the health and safety issue so we can continue with the escrow process.
Yeah. But there are times when a seller may not want to fix that. Then are we at a dead deal or?
No. So we have what's called escrow holdbacks. So for example, appraiser calls out $1,500 in health and safety issues that need to be corrected before the close of escrow. There are oftentimes the seller will not agree. And the buyer doesn't want to put their money out up front to fix somebody else's house because at this time they don't own it.
Right.
We can do what's called an escrow holdback. So let's say the repairs are $1,500. We need to keep 1.5 times in escrow the amount to cover those repairs after the close of escrow. And normally we want those repairs completed within 21 to 30 days at most, because they have to sell that loan.
So whose money is held back or?
It could either be the buyer or the seller.
Oh.
Because at this point we closed, right?
Right.
So now the buyer isn't risking his money on something they don't currently own. But maybe the seller doesn't have the cash at hand and they need that equity from the proceeds of the property that they're selling. That is how we can make that work in certain scenarios.
That's good to know. Because a lot of times I feel those health and safety issues can kill a deal completely.
And I will say, not all lenders offer the escrow holdbacks. So that is definitely something that our company offers. And it has helped, believe me. There's some deals that would not have closed if we weren't able to do those escrow holdbacks.
Absolutely. So speaking of doing things for a buyer, and earlier you had mentioned putting the client always in the best case scenario. Do you ever find where maybe a buyer is receiving inaccurate information regarding a type of loan product they should be obtaining? Again, I'm going to say, and I know I might sound like a broken record, but we have low inventory. And so I'm working with a buyer who's also a seller. They need to sell their home in order to buy the new home. But they're in a low inventory competition on a purchase. So they've got sellers who are not wanting to accept their offer because they still have this home to sell, right? And so a big thing right now is we're hearing is what they call a bridge loan, where they're obtaining financing without having to sell their existing home. That's not always the best loan product for a buyer. How do you handle that? How do you handle when they're maybe getting advice from somebody who's not a loan officer and saying pushing this loan that you don't feel might work for them?
First of all, it's a very expensive loan. Second of all, it's a complicated process. You have to be able to qualify for both properties moving forward. And there's also a loan limit on bridge loans. So for instance, where we live in a high purchase price area, you might not be able to get enough money to bridge that. So you just want to talk to your loan officer, have them explain the process. It is very detailed. I won't get into it here, but it's something that we can look at. Am I a fan of them? Not unless the scenario is a true scenario that's going to fit the best client's needs. Does that make sense?
Yes, absolutely. So how do you communicate with the agents as far as, like I said, what's best for the client's needs and even throughout your transaction? Like, what is the communication style you have with the buyer's agent? Do you get to know them? Is it more just professional? Is it you talk to the buyer, not so much the agent? Like, what's the agent's role, I guess? What do they play in this whole buying scenario?
They play a major part in the total scenario. And my biggest thing, and I know this about agents, communication. I always have my agents involved in the process from the beginning to the end. Even the listing agent. You just said a few minutes ago, low inventory, multiple offers. What is something that I feel is very important in that scenario? When I know a client is putting an offer in, and I know that, there might only be one offer or 17 offers, I always pick up the phone, I introduce myself to that listing agent, and I tell them a little bit about my client, only what they need to know in order to hopefully get their offer accepted. Because if you don't communicate throughout the whole process, you're going to get lost and you're going to get to the end. Now you have this big problem because you had no communication. That is the key in this entire industry. Relationship, making sure that you can establish the working relationship as you move through the transaction, because it all equates to the clients and their service that they're receiving. If they receive the same service, we're both on the same page doing the same thing, they're going to be happy, and guess what? They're going to come back, which is our goal.
The goal, ultimately, is always the goal.
Always the goal.
Okay, so now let's say we're at the end of the escrow process, getting ready to close. The buyer's getting ready to close on their new home. So at what point will the buyer sign their final loan documents? Because I'm assuming there's a process.
So when we get to the end of the process, what we have is a final CD that comes out. It's called closing disclosure. It again reviews all of the fees and the closing costs that we initially did at the very beginning of the loan application when we started the process. But now we're down to the end. Some things may have changed. You might have wanted to pay more to buy your rate down. Whatever it may be, we're going to go over the final numbers at the very end before closing. The bottom line will be very close to what it's going to be. At that time, we'll let the client know, okay, we reviewed all of this. Next step's going to be to sign your loan documents. Now, after a CD is signed, you have 3 days, business days, you have to wait before you can sign loan documents. Okay? So once we preview that and get through that, then you proceed to sign your loan docs. At that time, title will give you the information to either bring your check in, a cashier's check, or you can wire. And at that point, then we just wait for the normal process of all our final documents that we sign are reviewed by the funder. And at that point, when we've met all the conditions, the funder will fund, record. They will become now a homeowner.
And typically, how long is that process? How many days? I know you said the 3 business days for the review of the disclosure, but from signing those loan documents to getting their actual keys in California, because we are in California.
Well, we've signed loan docs at 12 a.m. and we're able to close 8 hours later. And that's in an emergency situation. A normal situation would be the day you sign your loan docs, you want to look at closing probably around 3 days after that.
So really, in a matter of a week from signing
The CD.
the CD,
Yep, the initial CD, correct.
you can become a homeowner. Love
That's
it.
our goal.
That's our favorite part.
Yes.
So now that we've already touched on the whole process, buying process, loan process for a buyer, I just want to ask you a few last questions regarding the industry as a whole. And one of the questions that I'd like to ask you, and hopefully you can answer this, is what do you feel the biggest misconception buyers have when they come to you or applying for a home loan?
I feel one of the biggest is getting misinformation from others, family members, coworkers, because they may have gotten a loan 3 or 4 years ago. Times have changed. The investors' requirements have changed. So please go directly to your loan officer before listening to the outside, because we are the professionals. And we are the ones that are giving the correct advice that you're going to need to move forward to make this happen.
So always check with your local loan officer or ask that your realtor for a preferred loan officer that they can speak with to get the correct information.
Yes.
So Pauline, in your experience, what would you say sets apart an average loan officer from an exceptional loan officer?
Great question. Communication, number one. Always communicate with every party that is involved in the transaction, because it is a stressful process as we move through. Mm-hmm. And if everybody can make sure to communicate, that is going to make that process so much smoother, to where at the end, everybody is going to feel, wow, I understood the process because of this great communication. And they feel good about knowing what they just did, which is spend the most amount of money they're ever going to spend is on a home purchase, correct? Mm-hmm. So that is number one. Number two, which I put up at number one also, relationships. Form those relationships with your agents, with your community members, showing that what your true goal is in your role as a loan officer and in running your business. Because at the end of the day, service, relationships, communication, those are the 3 things that you really need to succeed and to be superior above everybody else.
I agree. It's huge on the agent side. I definitely will say that. When I have a loan officer that picks up the phone and actually communicates with me and my client, I appreciate that.
And I think this is a Pauline thing, is passion. I keep using the word because I truly am passionate. I truly care about the client. I truly want what's best for the client. And I know it shows. And I know that I don't advertise anywhere. Everything is word of mouth, repeat referral from my previous clients. And I take so much pride in that. I really do. And I really, know that they're giving me an opportunity to help them. And I want to make sure I'm doing the best job for them. Because at the end of the day, that who's going to make me a success.
Absolutely. I agree. And so with everything that's on the news and what folks are hearing out there regarding interest rates, where do you see the future of the mortgage industry?
Well, we're making a comeback. It's been a really tough couple years in our industry since the rates went up about 1.5 years ago. It kind of stalled a lot of buyers sitting on the fence because, of course, when you're going from a 3-4% to a 7 8%, it's a little scary. So therefore, you need to explain to the clients that you are not married to your interest rate. you're really marrying your house. And so therefore, you want to explain to them the future of where we think the industry is going. Right now, the Feds just spoke. The interest rates are due to come down. I will go into detail with the clients on what that means for their payment, but the one thing that's the most important is that you are marrying the house, not the interest rate. So if you should get into contract, you close escrow, you end up at that 7%, which you don't like. You want that 4% back when. You can always refi when the rates come down and it's cost effective for you as an individual, because everyone is different. And so it might not be the right time to refi for you in a year and a half, but maybe for this person over here, it is. We will evaluate what is the most cost effective and the best time to do this. Now, with the last year and a half, with the rates jumping up, we have a complete list of clients that we have closed that when the rates do come down, we will be reaching out to them directly to refinance them. And like I said, if it's cost effective.
Right.
I will not move forward if I'm not going to benefit the borrower. Very important. You get a lot of solicitors out there, they're calling you, sending stuff in the mail. Listen, that's exactly what it is, okay? Call the true professional that you can literally go see and look at and get the feel of their trustworthy from just speaking with them, making sure that they are going to take care of you and your needs.
And looking out for your best interest, always, for sure.
Yeah.
I agree. So Pauline, I just wanted to thank you again for taking the time to come today and speak with me. All the information you've given has been just not only educational, but so insightful. So I want to thank you for that.
Thank you so much for having me. This really means a lot to me that I can share this information with clients out there. Hopefully this has helped at least, spark your interest. And we would love for you to reach out to us. Any questions, any way we can help you. Our team at Golden Eagle Mortgage is completely dedicated to taking care of the client and making sure their needs are met. Because as we know, you take care of the client's going to take care of you.
Absolutely.
So come to Golden Eagle Mortgage where your loan is done right.
Thank you everyone for watching. If you found this information to be helpful and insightful, please give us a thumbs up. Don't forget to subscribe. The link to Golden Eagle Mortgage Group will be down below. Don't forget to give them a call for all your home loan needs. And this is Donna Silva, where expertise meets excellence.